Most founders price their e-commerce business the same way they pick out a restaurant. They ask a friend, hear a fantasy story about the multiple their friend sold at, who wants to look good, who says they got a big number, and then they just pick out a price out of thin air. But here's the thing, you pick out a price that's too high, buyers ghost you. And if you set it too low, you may be leaving a ton of money on the table. So let's do this the right way. In this video, I'm going to walk you through the actual methods buyers are using to value businesses in 2025. By the end of this video, you'll have a number that's not just plucked out of thin air, but it's an actual range that you can defend.
Hi, I'm Nate Lynn. I sell companies like realtors sell homes. Specifically, businesses where the owner runs them remotely, like e-commerce, technology, internet companies, and professional service firms making anywhere between $1 to $30 million a year. I've been selling companies for over a decade, and in the last few years, I've sold 20 companies for over $121 million. If your business has strong cash flow and a buyer can run the business from any location, chances are I already know someone who wants to buy it. In fact, if that's the case, I guarantee I can bring you 30 serious buyers and get you an LOI in less than 4 months.
First, we'll start with the most basic approach, asset-based valuation. Then we'll move into market-based approach, what comparable companies are selling for. And finally, we'll look at the income-based method. These carry the most weight, seller discretionary earnings and EBITDA. And I'll throw in a bonus at the end for how to get a future value using discounted cash flow method, DCF. Put together, these methods will give you a low, a mid, and a high range that you can use to prepare a real range for buyers that you can stand behind. All right, let's start with the simplest one, the asset-based valuation. Think of this as, what are all the parts worth if we strip the business down today method. Here's the idea in plain English. You look at what the business owns. Things like your inventory, your equipment, cash in the bank, and even your customer receivables. Then you subtract what the business owes, like supplier bills, loans, and other debt. Whatever's left over, if it's a positive amount, is the asset value. Let me give you an easy example. Imagine you've got about $1 million in inventory. Then add another $200,000 between cash and equipment. That brings you to $1.2 million. Now, say you owe $400,000 to suppliers and in debt. Subtract that and you're left with $800,000. That's your asset value. So when is this useful? This is the bare minimum, the floor that your business is worth if all growth stops. But here's good news for you. Most businesses are worth far more than their asset value. My buyers don't just pay for inventory in a warehouse. They're paying for your cash flow, your brand recognition, your customer base, your reviews, and the systems that you've built. Asset-based valuation doesn't capture any of that, which is why it's just the starting point, not your final number. Now, let's move from what the parts are worth to what the market's actually paying. This is the market comparable method, commonly known as comps. Think of it like a broker price opinion. When you're selling a house, the broker looks at other houses in your area that are similar. They're looking for houses that are around the same size, same layout, and same condition. And they use those houses that sold to figure out what your house is worth. With businesses, it's the same idea. You look at similar companies that have sold recently, and you use those deals to estimate your value. Here's a quick example. Let's say your company makes $800,000 a year in profit to the owner. You check recent sales, and you see one similar business sold for 2.5 times earnings, another sold for 3 times earnings, and another 3.5 times. That means your value probably sits somewhere between $2 and $3 million. But here's the thing, you got to compare apples to apples. As an example, an Amazon-only e-commerce store is going to trade for something lower than a company that is selling on multiple channels and has a strong repeat customer base. But overall, comps are really powerful because they show what buyers are actually paying for right now in the market instead of just theory. Now let's talk about fusing together methods that both buyers and lenders are actually using. SDE multiplied by a comparable backed multiple. SDE stands for Seller's Discretionary Earnings. Don't let the jargon scare you. It's just a fancy way of saying the cash that the business can make one full-time owner over the course of a normal year. Here's how it works. You start with your net profit. Then you add back the owner's salary, but only one if there's more than one owner taking a salary. and you add back any perks that aren't essential to running the business. You can also add back one-time expenses that aren't going to happen again. That total is a simple way to calculate your SDE. Example, let's say last year your net profit was $600,000. Now add back your salary, plus any one-off costs, like a legal bill and a one-time only website rebuild. Now your SDE comes out to being about $800,000. Now comes the fun part. Let's pretend buyers in your space are paying between 2.5 and 3.5 SDE. Now, with $800,000 in SDE, your valuation comes in somewhere between $2 and $3 million. And that's why this method is so widely used. It's simple, it's grounded in a real profit, and it's how most businesses under $10 million are valued. Now, if businesses can run without you, meaning you've got a team in place, processes documented, and the business doesn't rely on you showing up every day. And if it's a bigger business, over $2 million in SDE, buyers and lenders often switch to EBITDA instead of SDE. EBITDA is just your earnings before interest, taxes, depreciation, and amortization. Basically, it strips out financing and accounting quirks so that a buyer can see how the business performs on its own. They'll figure out their own financing, and that figures into the debt service, which I'll explain in another video. Example, let's say your EBITDA is $2 million over the previous 12 months. Right now, similar businesses in your industry are selling between 4 and 6 times EBITDA. That would put your value in the $8 to $12 million range. So here's a rule of thumb. SDE for owner-operated businesses and EBITDA for bigger businesses with a team in place that's running it. Now, here's the bonus method for high-growth companies, discounted cash flow, or DCF. Now, this one sounds intimidating, but the concept is quite simple. We basically ask, how much is the business likely to make in the future, and what is that worth today? You project out the cash flow over the next few years and assume a modest growth rate. Then discount it back to today to account for probability and risk. Here's an example. Let's say your business generates $500,000 in free cash flow each year. Project that out for a few years with some modest growth, then apply a discount rate because the future is uncertain, and you might land on a valuation around $3 million. The goal is to show growth and to get to a higher valuation than the previous methods mentioned. The catch with DCF is that you have to reliably show a buyer you can hit those projections over 4 to 6 months in order to convince them that your business is worth that higher price. So it tends to make the sales process longer. So how do you put this all into one valuation range? If you're still very hands-on, use SDE. But if your business runs without you, use EBITDA. Do some research and apply the market multiples to get a low, mid, and high range. Make sure your low is not beneath the asset value method. Then project out your profit over time to do a DCF check. If it's way off, revisit your assumptions. Here's another example. If your SDE is around $800,000, and if you check your industry multiple and it's 3x, your business is worth about $2.4 million. That's your defendable price, something you can explain to a buyer without sounding like you pulled it out of thin air. Now, if at this point you're still confused, don't worry. You can understand the methods. You can even run some back of the envelope math. But the hard truth is, you can't actually pin down a real valuation on your own. And that's because the most important data, the multiples of businesses in your industry, isn't publicly available. These are all private deals. You can't just Google these. Sure, you can look at listings and listing prices, but those aren't what they sold for. And the marketplaces that do collect real sales data, you either need to be a broker on the marketplace or ask a broker. There are some websites that solicit brokers for actual sales data, compile the data, and then provides the aggregated data back in return. But you have to have your own sales data to submit to them in order to qualify for the other data in return. So here's where a broker like me brings immediate value. I see live deals close every week across multiple marketplaces. I know which categories are heating up, what businesses buyers are staying away from, and what multiples are actually closing. That's the difference between hoping your number stands up and knowing it will actually stand the test of negotiations. And beyond the price itself, there's also the process. Coming up with a fair valuation and getting paid at the top of that range are two completely different games. The fastest way to lose valuation is to walk into a deal with just one buyer. I bring multiple buyers to the table at the same time and create real competition. That's how you hit the top of the valuation range and sometimes beat it. Here's what I want you to do right now. Use the framework I just walked you through to get an idea of your own valuation range. But when you're serious about selling, don't try to DIY it. Reach out to me. I'll give you a broker's opinion of real price based on comps. And then, if you're ready, we'll run a competitive process to get you the best price possible.